the quick assets are the 528 divided by the current liabilities, also goes up, improves, and then the working capital 750 minus the 380, and so that increases as well. All right, when we take a look at the next transaction, we're going to have to open up some more cells. So we notice what we have here: A, B, C, D, E, F, L. So that doesn't go in. So we're going to have to open cell or unhide cells. There's hidden cells in there. So I'm going to put my cursor on N so we can see the drop down. Left click, drag over to L, let's go. Right click the selected area and unhide. So we're going to unhide those cells. Then we're going to hide these cells. I'm not going to delete them, but I'd like to hide them for now so we can just see what we are working on. So I'm going to put my cursor on the B column so we can see the drop down. Left click, drag to F, let go, right click on the selected area and hide. Okay, so now we're up here. We are now on 513, where we're going to say that we purchased merchandise for cash, $275. So we're on 513, purchase merchandise for cash. So is cash affected? Yeah, we purchased it for cash. And so cash has a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit. So I'm going to copy the cash. I'm going to put that on the bottom. So here's the date. Going to put it on the bottom of the date. Right click, paste, 1, 2, 3. And the amount is for credit $275,000. We're also going to debit something, of course. That debit will be to merchandise. That's what we purchased. We purchased merchandise. We purchased merchandise before, but this time we purchased it for cash. Last time we purchased it on account. So it has a debit balance. We're going to make it go up by doing the same thing to it, which in this case would be another debit. So I'm going to copy that. I'm going to put that on top in cell H6. Right click, paste, 1, 2, 3. Okay, so let's post this out and see what happens. So here's our merchandise, and here's our merchandise. We're going to post that here. Something's in there. Therefore, I'm going to double click on that, go to the end of it, say plus, point to that 275, and enter. So notice what happens. Our current assets went up. However, our quick assets did not. So it's not part of our quick assets. It is part of our current assets. And then we're going to go to post cash. Here's cash. Here's cash. And here is where we're going to post it in N6. Double click, go to the end of it, plus, pointing to cash, and enter. That decreased the current assets as well as the quick assets. So the cash is going to bring down the current assets and the quick assets. However, the current assets went up and down. We got a current asset, inventory, and we lost a current asset, cash. On the quick asset side, we didn't get a quick asset because inventory is not included, and cash went down. So let's see what the effect is on our ratios over here. We are now on 513. We are going to say that our current assets are at 750,000 and no change. Why? Because it went up and down. Cash went down, merchandise inventory went up. However, the quick assets are now at 253,000 because the inventory isn't part of the quick assets. The current liabilities, no change. We didn't affect the current liabilities, and therefore 380,000. And therefore I'm going to recalculate these. We're going to say that the current ratio then is still the 750 current assets over the current liabilities 380, no change. But the acid test ratio now is the quick assets over the current liabilities, and it's gone substantially down on the purchase of inventory. So the purchase of inventory for cash will substantially reduce because the inventory is not included in the current asset or the quick assets. And then the working capital equals the 750 minus the 380. All right, let's see what we have next. We're going to scroll back over here. We are now on 516, which says we paid a cash dividend or cash dividend declared. Amount of shares outstanding, amount per share 1, and their shares outstanding are 80,000. So we declared a dividend. We have not yet paid the dividend, and that was on 516. So to think about that, then we're going to say, is cash affected? Not in this case, because we declared it, we haven't yet paid it. Therefore, what's going to happen is we owe money because we've determined and we've made a commitment to pay the dividend. and that's going to be called dividends payable. So it's a liability account here. We have obligated ourselves to pay a dividend in the future. So notice that the liabilities accounts have credit balances. We're going to make it go up by doing the same thing to it, which in this case will be another credit. So I'm going to copy the dividend payable. I'm going to put that on the bottom because they usually go on the bottom. And we're going to credit it for 80,000. So it's $1 per share. There's 80,000 shares outstanding. Then we're going to debit something. What are we going to debit? Now remember what dividends are. So they're basically going to be similar to a draw for a sole proprietor. Basically, we are giving the money to the owners. The company has generated revenue. We are now paying it to the owners. If it's a sole proprietor, the owner just determines that they want to draw, and they can just draw the money out. If it's a corporation, then the corporation has to declare the dividend, and the owners may have less control depending on how much shares the owners own in the company. So in this case, the company has decided to pay the dividends to the owners being stockholders in the form of a corporation. It's going to be paid out of retained earnings being the accumulation of net income over time throughout the business. So note it has a $300,000 in it. It's got a credit balance. We're going to make it go down by doing the opposite thing to it, which in this case is a debit, because after we pay the dividend, we no longer owe the shareholders that money. This kind of represents how much money is owed to the owners being the shareholders. Right-clicking and pasting 1, 2, 3. All right, so let's post this out and see what happens. So now we're going to be down here on the retained earnings. We are in N16. We're going to say that equals, point to this 80,000. That's going to bring this credit balance down to 220. Then we'll go to the payable account in N13. I'm going to say this equals and point to this 80,000 for the dividends payable. That will make the current liabilities go up. So notice no effect on the current assets or the quick assets. The numerator in both of our ratios has now gone up, which should bring the ratios down. So we're going to say on 5/16, what happened now? Well, we still have assets of 270 for current assets. We have quick assets of 253, no change. But current liabilities is now at 460. So let's delete this. Excel's trying to help me there again, trying to help me out. But we're going to say that the current ratio then is going to equal the, let me delete that. This should be 75,000, 750,000. Sorry about that. So we're going to be over here in U13. We're going to say this equals the 750,000 divided by the current liabilities of the 460, which have gone up. That brings our ratio down. So we're going to say the quick ratio then will be the 253 over the current liabilities, which have gone up. Quick asset test ratio gone down. And then our working capital is going to be the 750 minus the current liabilities, and that has gone down as well. All right, let's take a look at the next transaction. We're now down here on 5/19. Wrote off accounts receivable to allowance for doubtful accounts. So 5/19. So we wrote off the accounts receivable. So what's happening is someone came in, or we determined that a part of the accounts receivable here is no longer going to be collectible. So we're saying that part of what is owed to us, we're not going to get 5,000 of that from a certain client. Maybe they went bankrupt or something like that. The receivable has a debit balance in it. We need to make it go down because we're never going to get that money. So we're going to credit it. We're going to do the opposite thing to it. I'm going to copy this. I'm going to paste it 1, 2, 3 underneath the date. We're going to credit it to reduce the receivable by 5,000. Now, as we know, there's two methods to do this. There's a direct write-off method and an allowance method. The generally accepted accounting principles requires an allowance method if the amount is substantial, meaning it's material to decision making. And therefore, we've already basically made an allowance for doubtful accounts. And notice that this problem is a little off. It seems a little unusual because after we receive that 90,000, we now have receivables that are less than the allowance, which seems kind of odd. But in any case, that was probably a bad estimate on our part. But we're going to say then that we've already created an estimate of the accounts that we believe are going to be uncollectible. So therefore, we're not going to write off into bad debt when the account actually becomes uncollectible, all we're going to do is say this is going to go down. The allowance accounts basically says, hey, we already estimated that some people were not going to pay us. We did not know who yet. Therefore, we're just going to reduce the allowance as well. Notice this is a contra asset account, meaning it's an asset account with a credit balance in it, unlike all other asset accounts for the most part that have debit balances. And therefore, we're going to make this go down. The contra asset is going to go down. It's a credit. We're going to debit it. So I'm going to copy that. Going to paste it 1, 2, 3 in H12. Right click, paste. 1, 2, 3. All right, let's post this out. So we got the allowance for bad debt. We're going to post that to N8. Say equals, point to the 5,000. That's going to bring the allowance down. So that did bring both the current assets and the quick assets up. But then we're going to post the other side to accounts receivable. Something is in it. Going to double click on it. Go to the end of it. Say plus, point to this 5,000 credit. That's going to bring the receivable down. And so notice what happened then. One account went up for both current asset and quick assets. One account went down. There's going to be no effect. And once again, I know that the net effect before was a negative 2,000, meaning that we overestimated the allowance, and it's still a negative 2,000. So that means that our receivables are actually a negative 2,000, which again the estimate needs to be adjusted. But in any case, what would be the effect of that journal entry on our ratios? We would have to say that as of the date of, what was the date here, 5/19, there's going to be no change on the current assets, 750,000. There's going to be no change on the quick assets of 253,000. The current liabilities, no change of 460,000. And therefore, I'm just going to let Excel calculate those for us. There's no change. All right, so then we're going to go down, take a look at the next transaction. We are now on 5/21. It says, pay cash to settle accounts payable. All right, so now we're going to pay cash to settle the payable. So here's the cash. Is it affected? Yeah, we're paying it. Cash has a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit. So I'm going to copy the cash. I'm going to put that on the bottom of the date. Right click, paste, 1, 2, 3. The amount that we are paying is 12,000. We're going to have to debit something by 12,000. What are we going to debit? In this case, the payable. So we're paying off the amount that we owe. We know we're going to debit it. We know that payables have a credit balance. We know that if we debit something that has a credit balance, we're doing the opposite thing to it. That will make it go down. That makes sense because the payable should go down after we pay it off because we don't owe it anymore. So I'm going to copy the accounts payable. We're going to put that in H15. Right click, paste, 1, 2, 3. Let's post this out, see what happens to our accounts. Here's the payable. Here's the payable. Here's where we want to post the payable. Something's in that cell in N12, so I'm going to double click on it, go to the end of it, plus, point to that 12. That's a debit. This is a credit. It's going to make this account go down. Then, and note that, of course, that made our current liabilities go down. Then we're going to go to the cash account. So here's cash. Here's where we want to post cash in N6. Something's in it. There's a lot of stuff in it. So we're going to double click on it, go to the end of it, and plus, point to that 12. So note what happened. Both the current assets and the quick assets went down, and the liabilities went down. So both the numerator and the denominator of both of our ratios went down at the same dollar amount. So then we're going to scroll over here. We're going to go to 5/21, and we are now at current assets of 738,000, current quick assets of 241,000. Those both went down by the amount paid. And then the current liabilities went up 448,000. All right, I'm going to, something looks funny. This should be 738,000. All right, let's do that again. So now I'm going to calculate these one more time. We're going to say this current ratio equals the current assets divided by the current liabilities. So that brings this up slightly, even though, once again, the numerator and the denominator are changed by the same dollar amount. So notice that that can happen. We're going to say here equals the quick assets over the current liabilities. And again, notice slight change, even though the numerator and denominator had a change by the same dollar amount. And then we're going to say that the current assets, or the working capital, current assets minus current liabilities, is unchanged. there was an equal change to current assets and current liabilities. All right, let's take a look at the last one here. I think this is the last one that we get to do, and then we have to stop this. So we're going to go down to 530, which says we paid the dividend declared. So you'll recall that we declared a dividend in the past. We are now paying it. What are we going to pay it with? Cash. Is cash affected? Yeah, we're going to pay cash. Cash is going to go down. Cash has a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit. So I'm going to copy cash. I'm going to put it under the date in H19. Right click, paste it. 1, 2, 3. Cash is going to go down by the 80,000. Why? Because that's how much we declared that we're going to pay, and we could see it here in this journal entry. We could see it here in the payable. That's how much we owe. Credit 80,000. We're going to debit something. 80,000. All right, we're going to debit something for 80,000 as well. What will the debit be? Well, we already declared the dividend and recorded this payable, as we recall. That payable is now being paid. Therefore, that needs to go down. How do we make it go down? It's a credit. We're going to do the opposite thing to it. Therefore, the opposite of a credit is a debit, and we're going to debit the payable, reducing that payable. So let's post this out and see what it looks like. So here's the dividends payable. We're going to record it here. Something's there, so I'm going to double click on it, go to the end of it. Plus, we're going to point to that 80. That should bring this balance down to 0. Notice that what that does to the current liabilities brings it down. Then we're going to post to the cash. So here's cash, here's cash, here's where we're going to post cash in 6. Double click, a lot of stuff in it. But we're just going to go to the end of it and say plus, and point to that 80. That's going to bring down the assets, going to bring down current assets as well as quick assets. So both the numerator and the denominator are affected on this transaction. Let's see what's going to happen to our last calculation on 530. So we're now on current assets are now at 658,000, went down. We're at quick assets of 161,000, went down. Did I do that right? Yep. And we are at current liabilities 368,000, went down at the same dollar amount. It calculated it for us, but since this is our last calculation, we really want to do it ourselves. So we're in U16 now equals the current assets divided by the current liabilities. And note, again, change, even though there was a similar, the same dollar amount on both the numerator and the denominator effect. And then the quick assets equals the 161 over the 368. Again, slight change. And then we're going to say current assets for the working capital minus the current liabilities, no change, because again the dollar amounts were affected in the same amount for current assets and current liabilities. All right.